A lot of people, of course, seeing those images on social media of people standing in line trying to pull out their money. This is the second largest bank failure in America's history. 2 days after regulators shuttered SVB, Signature Bank became the third biggest bank failure ever in the U.S. So what is the government doing here to make sure that more banks don't fail? Could these banks have been saved if regulators intervened sooner? South Dakota Republican Senator Mike Rounds is a member of the Senate's Banking Committee, and he joins me live right now. Senator, good morning to you. Is the government system that is in place to ensure that banks don't fail asleep at the wheel?
I wouldn't say that they're asleep at the wheel. I'd say they're still learning what happens when you have a unique type of circumstances with very large depositors that are specific in terms of the technology and healthcare sectors. What you found in this particular case was a large group of individuals who had very common interests and needs, and they needed a lot of cash in a short period of time. And with a bank that had grown very rapidly and who had plenty of reserves, but the reserves were in long-term U.S. government securities, they simply, when they tapped them, they had to take a loss. And in doing so, the Fed had to step in. In the meantime, a lot of these creditors, these depositors, talk to one another. And as they watched this thing transpire, they decided that they were going to pull their money out of the bank rather than wait and see what happens, because they needed the cash. And so you ended up with a unique situation in this particular case where a lot of folks who knew each other were actually together and talking and had needs at the same time, with a bank that, while they had a capital, the capital was in long-term government bonds, secure bonds, but ones that had a lower interest rate. And so when they went to cash them in, they didn't get all their money back in order to pay off their depositors.
And you mentioned, I mean, this is people, companies that have larger deposits, I mean, $250,000 or more. So there are a lot of people who don't have that kind of cash. But it seems that Silicon Valley has been having some issues as of late between the layoffs and then this particular failure where there are a lot of tech companies who invested money in these particular banks. Should everyday people be concerned about their own banks? Say if they bank at a place like Bank of America or Wells Fargo, that this could happen to them?
I think the vast majority of the folks that are out there should not have concerns about bank failures. The program that has been in place since the 1930s has been strengthened year after year. And it's one in which we watch banks very, very carefully. And when you do have a bank failure, there are processes in place in order to make sure that the depositors are protected, in this case up to $250,000. And since these were significantly larger creditors, and a lot of businesses may have more than $250,000 in a deposit, the Fed actually stepped in and said, look, in this particular case, we're going to cover it all. We've got resources, we've got systems in place so that we do have access to additional funds. Longer term, if we think it's necessary to go above that $250,000 limit, and it may very well be the time to talk about it, we'll have to figure out who should pay for that extra protection, whether it should be passed on to a very large group or if it's an item on a case-by-case basis where individual depositors may want to be able to purchase additional coverage for their extra coverage above $250,000. All of those should be on the table. But there is no such thing as a perfect system, but the one that we've got in place right now is really good. And if you take a look at it, the folks who are going to lose money here are going to be the folks that owned the bank and had invested in the bank, but the depositors will not lose their money.
Well, that's certainly comforting. I know Treasury Secretary Janet Yellen will be testifying before the Senate Finance Committee today, saying no taxpayer money is being used to protect these bank customers. I just want to make sure that's accurate, correct?
As near as we can tell right now, there is no direct payment out of a government fund into this. There is a separate fund which banks pay in as they put fees into an account, which is designed to protect in case we do have a failure of the system where a bank goes under, like in this particular case, and you've got to pay back depositors the money. There is a separate fund which banks put money into. So if you're a taxpayer, but you've also been paying bank fees, some of those bank fees may very well indirectly go back into the banks paying this part of the bill as well. So to say that taxpayers don't pay it, consumers pay it one way or another in terms of higher bank fees.
Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.